Why does it appear that everywhere governments are making great promises, cutting spending, and yet we have an ever-increasing debt load? Why does it feel like your taxes are increasing, but government services are deteriorating? Why did the real estate bubble occur, and why is it still so difficult to get out of it? Why does it appear that social inequality continues to increase? Why has Japan experienced what we commonly call the last 2 decades? Why does Europe appear to be coming apart at the seams over the euro? Why do we keep on seeing ethical lapses on Wall Street? Why are there bank lines in Cyprus? Why are there riots in Greece? Why does it appear? Why does it? 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 Why? Is it possible that what appear to be disparate elements are in effect connected by a common theme? Yes, that common theme is what we dealt with in a conference at the Federal Reserve Bank in Philadelphia in April of 2013. Hi, my name is Kortsch, and I'm the CEO of Global Partners Investments. I was asked to organize that conference. We brought together world-class leaders, thinkers in economics, and looked at these issues and what can be done with them, to look at radical solutions to what we are currently facing worldwide. Our dignitary speakers include Professor Jeffrey Sachs of Columbia University, twice listed by Time magazine as one of the 100 most influential people in the world. Larry Kotlikoff, economics professor at Boston University and formerly on the President's Council of Economic Advisors. Lord Adair Turner, former chairman of the British Financial Services Authority. David Kotok, the CIO and CEO of Cumberland Advisors. Bill Poole, former president of St. Louis Fed. Michael Kumoff of the International Monetary Fund. And me as a wrap-up speaker. All of those speeches are online in full at a website that we will give you at the end of this short overview of what we experienced that day. And I trust this will give you an idea of what we went through. The theme was our fractional reserve banking system, how money really works, not only in our country but in the whole world, and some radical solutions towards that. I want to start off by looking at banking as it actually works. And here's a short clip by Michael Kumoff of the International Monetary Fund dealing with deposit creation.
The key function of banks is money creation, not intermediation. And if you tell that to a mainstream economist, that's already provocative, but it is 100% correct. Okay? What banks do, and I was a banker at Barclays Bank for 5 years, I made loans, I know exactly what the entries are that you need to create when you make a loan. You create a new loan on the asset side of the balance sheet, and when you do that, you create a new deposit of exactly the same amount that is credited to the guy who has just borrowed from you. Okay? So this is the only time I'm going to use this little board here. When the bank makes a loan, its balance sheet is like this. When it creates a loan, it creates an additional loan entry here. And the customer, let's call him X, that's the customer X, and it creates an additional deposit entry here, change in deposits, delta D. It's also in the name of X. The bank, at that moment, creates new money out of thin air, and I will go into more detail about that now. Now, how about intermediation? A common definition of intermediation is that the banks, or the banking system as a whole, and it's important to make that distinction, accepts non-bank deposits of savings, somebody's savings, and then lends those savings out to somebody else who needs them. Okay? Under this definition, banks are not intermediaries. They never, ever do that. Okay? Because what they do is this. And this is not intermediation because this guy, X, is the same. So in terms of causation, the critical issue here is that loans come before deposits. Loans create deposits. and not vice versa. What the intermediation story misses completely is the monetary nature of financing. So let's go into more detail now. What story would I have to tell the intermediation story? Well, let's have a scenario where A wants to buy goods or assets, doesn't matter, and B wants to sell goods. Now B dumps the goods at the bank, and a deposit is recorded. And then the bank gives the goods to A, and a loan is recorded. That story is, of course, complete nonsense, because that never happens, right? But that's how you have to argue if you say that banks intermediate funds, intermediate savings from some guy to some other guy, because that implies that deposits come before loans. What you have to ignore for this is, of course, if somebody comes into Bank A and brings in a check that's drawn on Bank B. That's a micro phenomenon. That doesn't change the overall amount of loans and deposits in the economy. It just reshuffles them between different banks. That's not relevant for this argument. And cash deposits are also not relevant. First of all, cash is a tiny item in terms of the overall bank business. And banks never lend out cash directly. You only draw out cash against an existing deposit. So the intermediation story is a completely impossible story, yet it dominates in today's debate. It is also known as the loanable funds story. The money creation story, we start with the exact same scenario. A wants to buy goods, B wants to sell goods. Now, A goes to the bank to get financing, and B stays at home. He has nothing at all to do with this. Okay? A gets a new loan of $1 million and a new deposit of $1 million. What the bank has done here is to create its own funds, deposits, in the act of lending. It has not had to wait for anybody to deposit something first in order to make the loan. It created its own funding. That's, of course, an absolutely extraordinary privilege that's not enjoyed by any other kind of business.
We've now learned that it takes debt to create money. Every time you take a loan out, part of that money is created out of thin air, or what we say ex nihilo, fancy word. But what's even harder to understand is the opposite. What happens when you pay part of that debt back? When you make a mortgage payment, when you pay your car off, what happens? You're actually destroying money. It's not just that you do not have the proceeds of your loan anymore. You are actually taking money out of circulation. That's a difficult concept. Well, what happens when millions of people, when most of society is trying to do that because we've taken too many loans? We call it a deleveraging economy. And that's what creates the difficulties that we are currently facing. Since the Great Recession of the beginning of 2008, the Federal Reserve Bank has been printing, we use that word. It's not like the printing presses are running all the time. It's only a small portion that is physically printed. The rest is just electronic money. You understand that. We call it quantitative easing. Let me keep on using the printing word just because it's easy in all of our minds. They have been printing a steady stream of new money in order to compensate for the money that we are destroying by getting rid of the leverage, the debt that we have taken on. Currently, they're printing $85 billion a month. Back to the Great Recession, since that time, the assets of the Federal Reserve Bank have increased from about $900 billion to $3.3 trillion. Here's a short clip by David Kortsch going through this process. Remember David is from Cumberland Advisors, and he's an expert on this subject.
This is the Federal Reserve. We all see this all the time. We call this rainbow chart, something we put on our website at Cumberland Advisors. You're all welcome to come look at it. We now have 20,000, 30,000 visitors a week that look at the series of central bank. But why they come to us, I don't know. The data is available to anybody, but I guess we make it convenient for them. All right, where are we? We were here, 900 billion in size, most of it treasuries. Then we had a little excitement called Lehman, AIG, a few other things. We had this big rainbow of Fed programs. They're running off. And now we're about 3 trillion and climbing every month. And a big pot of it is mortgage-backed securities, and the rest of it is in treasuries. And the treasuries are now long, intermediate, short. They're no longer just short.
David goes on in his speech to show how the four largest central banks in the world, or what we tend to call the G4, have been on a tear, printing, that word again, and they've gone from about 3.5 trillion to 11.5 trillion. This is a global experiment. We have never, ever done this before. Not in the whole world. Did we ever think this was going to happen? Here's another short clip from David on this subject.
The growth rate of the size of the central bank's balance sheets is accelerating. Think about that. We had this meeting 6 years ago, and somebody were to stand here and say, 6 years from now, we're going to come together at the conference, we're going to have the central bank's balance sheets of the world go triple the size, accelerate the growth rate, and when we do it, we'll have a large negative output, high unemployment worldwide, next to zero inflation, the short-term interest rate will be near zero, the long-term interest rate of high-grade sovereign debt throughout the world will be somewhere between 1% and 2%. Everybody in this room would have said,
Let's look at our system in a bit more detail. We have what we call a fractional reserve banking system. What does that mean? Well, it means that banks only hold a fraction of the deposits. How big is that fraction? Well, in the US, as an average, it's just under 10%. Give or take, that's about where it's at. What is a reserve of the fractional reserve banking system is what banks have in their vault plus in deposit with the Federal Reserve Bank. All right? The system works just fine as long as we all leave our money in the banks, as long as we trust what the bank is doing. You see, when you deposit, say, $100 into what you think is your bank account, well, it is your bank account. It's not your money anymore. You have now traded your $100 that you've deposited in the bank for an IOU from the bank that simply says, when you want it, we promise to pay it back to you. Well, you understand, if the bank only has a small portion of that $100, how does it pay it back if everybody wants it at the same time? It can't. We have what we call a bank run. The bank may be in good position from a net asset value. The problem is liquidity. The bank cannot fast enough liquidate its assets, loans, investments that it has, in order to pay everybody back, and we get a bank run. Here is Larry Kotlikoff of Boston University to give us some of these issues that we are currently experiencing.
I want to first of all kind of summarize where we are. And I think the big thing to say is that Wall Street, broadly defined, has become a very dangerous place for Main Street. We've had two global financial crises in the last 5 or 6 years, devastating impacts on hundreds of millions of workers and retirees. One was centered in the U.S., one was centered in Europe. Still ongoing in both places, I believe, fair to say. The next one might be centered in China. So what's really going on? Well, some people think it's bad assets. Here's a couple examples: sovereign debt and subprime real estate mortgages, bad assets. Other people think it's just bad banks. The bankers are the bad people, and the bad guys here, and we got all these banks. I should have added a couple Cypriot banks at the end here. Bank of Cyprus and Lycia should be added to this, so that's about 29 bad banks we could list right away. Other people think it's bad regulators, bad financial rules, bad governance, bad politicians, bad bankers again, bad disclosure, bad leverage, bad luck.
Larry goes on and describes how the two primary problems with our banking system come down to two words, really: opacity and leverage. Opacity simply means you can't see it. You can't see, once you deposit money with the bank, you have no idea what the bank actually does, within the constraints of banking law, I understand. And leverage is the fact that in order to create the debt that it lends out, the bank is leveraging funds on its own, as we've already described. All right, how does that work? Well, here is William Poole, former president of the St. Louis Federal Reserve Bank, dealing with this issue of opacity, because what you'll hear him say just now is even a PhD economist cannot tell whether a bank is in good shape or not.
Now, investors in banks do have an information deficit, and Larry Kotlikoff emphasized that point. Suppose, it's a beautiful day out here, suppose you're walking down the street and a well-dressed man, suit, tie, approaches you and says, "I am a bank. Please deposit $100 with me and I'll keep it safe. And here's a little book and we'll sign you up. And you can have it back at any time." Well, your reaction, of course, is this guy's a nut. And you don't just hand over $100 to somebody walking down the street. However, if you walk past a building that has impressive pillars, iron grates over the windows, and the word bank in gold letters up there somewhere, you may be quite willing to walk in and deposit your $100 without much investigation at all. And of course, it's FDIC insured. But the fact is that there is no possibility that the average PhD economist, even, I think, the way up in the upper tail trained PhD economist, trained in finance, can determine the safety of a bank. Of course, the reason is that the publicly available information just doesn't tell you what you really need to know about the quality of the assets.
Dr. Poole goes on and deals with the second issue that Larry has already brought up, which is the whole aspect of leverage. And what he's saying is that regulation, even though we've a lot of it, is no substitute for good capital. Once again, here's Dr. Poole.
Given regulatory experience in the United States and elsewhere, regulation of bank activities is not an adequate substitute for capital. Regulators, and apparently bank senior management as well, can have the same difficulty private investors do in understanding what a bank is doing. And finally, as I've already emphasized, regulators are subject to political constraints to encourage certain activities, such as housing. The actual record of regulation and the constraints we understand through the public choice literature destroy, and I don't think that's too mild a word, destroy the case for regulation as a substitute for adequate capital.
Well, you can see that there's general agreement on the banking issues that we face within our current system. You now have two totally separate speakers addressing the same two issues in very different ways. They were not asked to do that. They came up with this on their own because that is the truth. All right, allow me to make a few more points before we get to solutions. Here's a portion of my speech dealing with banking instability. Here's what I would say. Here's our monetary system, our banking system. All right. So what it is, it's this huge monolith, menhir, and it's standing on a point. All right? It's very unstable. Now you notice we've created some really nice rocks here at the bottom. So these are stability systems that are part of what it is that we've created. That's the FDIC. That's, all sorts of regulatory constructions that we've created that help us stabilize this block. All right? But we've got these big guys. I'd say that this is the Fed here in the United States that is working to stabilize a highly unstable system. And I am in a Fed building, and I want to praise them because I think they've done a phenomenal job for a system that I would consider as inherently unstable. And essentially everybody has said that today. You have heard that. We may disagree on different policies, systemic issues, whatever. We've all agreed the system is highly unstable. So we've got these guys. They've done a good job. I mean, this is the 100th anniversary. Wasn't it 2013 the Fed was created? It's the 100th anniversary. And it's not that we haven't had any problems, but by and large, I can't believe how few problems we've had, considering the essential nature of what the system looks like. Well, let me show you another thing about this picture. Those are all human beings. Those are little people down there. They actually cover everything, but then, of course, the whole picture wouldn't make any sense. When that big monolith falls down, it crushes those people. And that's what we're talking about today. It's a very important subject. In my speech, I'll make another point this time on social inequality, because we know it's a serious issue in our society. Let's talk about social inequality. Remember, I'm zipping through this really fast. Here's a paper written by one of our very own, member of the GIC, John Sylvia, chief economist of Wells Fargo. So we don't have to go very far to look at social inequality. So here's the abstract from the paper. We study the effects and historical contribution of monetary policy shocks to consumption and income inequality in the United States. And the same can be said essentially for the whole world. Contractionary monetary policy actions systematically increase inequality in labor earnings, total income, consumption, and total expenditures. Let's see now, what part of the economy is missing here? There must be something missing. No, there isn't anything missing. Furthermore, monetary shocks can account for a significant component of the historical cyclical variation in income and consumption inequality. Using detailed micro-level data on income and consumption, we document the different channels via which monetary policy shocks affect inequality, as well as how these channels depend on the nature of the change in monetary policy. What it says is, when people are doing everything correctly, the system, inherently the system itself, creates inequality. And now I need to make a short clarification of what I just said on that clip. Now, this is a conference on banking. It's not a conference on social equality. Now, I'm not going to stand here and tell you that the banking system creates all that inequality. I think that would be patently wrong. All I'm saying is that, like I said, even our very own agrees that the very banking system that we have is a significant part of a social problem that we do need to deal with. Finally, in review of our banking and monetary system, here's a short clip by Professor Jeffrey Sachs of Columbia University talking about how the very regulatory environment that we have created tends to lead toward ethical lapses.
So this is where I would start, actually. I think the macroeconomics is important, but I think that the lawlessness and the sense of the world in the complete impunity of the system is absolutely massive. And wherever you look, we see the same thing continuing till today, and that is massive, massive bonuses at the top of the financial markets, massive civil fines being paid for really incredible behavior, and massive campaign contributions going from this financial leadership to the political class.
Perhaps here in the US we are allowed to make these kinds of mistakes. On the other hand, perhaps not. I think we tend to forget that as the world's largest economy, we tend to be the elephant in the room, and when we catch a cold, the rest of the world can easily get pneumonia. Here again is Dr. Jeffrey Sachs on the global implications of the structure and elements of our monetary system.
And maybe it's useful to just share with you a sense that I received a few days ago in meeting with about 100 UN ambassadors who are discussing the global economy and global policy framework for the period from 2015 to 2030, which is very much the United Nations agenda. What was palpable in the room was a very, very deep sense of anger and grievance at the American financial system. And I think that this is important to state because we have our debates as if we're, sometimes operating in a cocoon in a way, and the rest of the world, especially the developing world, feels that they have been the victims of the U.S. And its mismanagement over the last few years. And I think that it's a geopolitical reality that is a very real and very justified one. In other words, the sense of the 2008 crisis is, you did this to us. and the failures of regulation in the United States have contributed markedly to instability and economic stresses in other places. And as several of the ambassadors reflected, the U.S. and the IMF more or less treat the policy discussions as if nothing really has happened. And what several ambassadors said is, why is it that we're taking advice from the people who have mismanaged the financial system so badly? So I think this is not an insignificant context. It's hard for the key currency and the center of the world financial system maybe to hear this very well and to take it as seriously as it should be taken. But the backdrop from the world's point of view is that the United States has failed badly in financial management, and that the implications of that are felt around the world. My feeling about this is actually similar. And I think that it's worth speaking outside of the monetary and macroeconomic framework for just a moment. And that is to reflect on the Fed's role as a regulator and on the real lessons of the financial crisis since 2008. And the angle that I would emphasize in this, again, I think is not typical for us as economists, but it is the massive illegality that has been exposed in the system.
Okay, let's get to some solutions. What was presented at the Federal Reserve Bank on that day in April were two elegantly simple points. First of all, to replace the fractional reserve banking system, and second, to create a new way of printing, if I may use that word, money in order to have continuing price stability. That's it. It's really that simple. Only those 2 points. Let's look at those in more detail. First of all, the replacement of the Federal Reserve banking system. We would go on to what I would call Glass-Steagall on steroids. That means that the payment portion of the system would be a trust banking system. What does that mean? When you deposit the $100 that I was talking about earlier into your bank account, it is still yours. The bank does not have free choice anymore as to what to do with that money. It can only do what it is you tell it to do with that money. Well, what's that? Well, if you write out a check, the check will be good. If you spend money on a credit card, the bank will pay your credit card. Obviously, only to the amount that's in your bank account. We know that. On the investment side, we would have a series of mutual funds represented by the risk, etc., of what it is that you desire. We're going to go into more detail on that later as we talk about this issue which was presented by Larry Kotlikoff. What does this do? This means that it would be impossible for bank runs to exist anymore. We would stabilize Europe in a heartbeat, at least for several years, with some of the issues that they're facing. All right, let's look at point number 2. How do we create new money? We have a new entity, let's call it a monetary commission. Doesn't really matter what we call it. My suggestion is that we have it controlled by the Federal Reserve Bank, but owned by the citizens. This means that as new money is created, the seigniorage for that money would actually go to us as citizens. What's seigniorage? Seigniorage is the difference between the cost of producing money and the value of that money. Let me give you an example. Let's talk about a physical $1 bill. Let's say it costs 1 cent to print that bill, but of course we know it's worth $1. So the difference between the dollar and the 1 penny is the 99 cents. That seigniorage would go to the government. What would that do? Instantly, your taxes would be lowered, your services would increase. We would live in a different world from a governmental perspective. This is not some new crazy thinking. This initially came out of the 1930s at the end of the Great Depression, was vetted by the top economists of that day. Over 230 of them signed off. That was pretty well the whole economic establishment at that time. Here is Michael Kumoff of the International Monetary Fund in a clip from his speech giving the advantages of this plan.
All right, so having set the stage, now the 6 advantages of the Chicago plan. Fisher identified 4 advantages, we found 2 more, and this summarizes them. Dramatic reduction of public and private debts, complete elimination of bank runs, much better control of credit cycles, output gains, and elimination of liquidity traps, and therefore the possibility of zero steady state inflation.
So how do we get from the current fractional reserve banking system to this new, what I call a trust banking system? Michael Kumoff gives an excellent, lengthy overview of that process. It can all be done over a weekend because it would be planned in advance, but it's a very powerful process. Because you see, what we need to do is top up with the banks this 90% that is missing so that we do not have a fractional reserve anymore, but the full capacity of the depository aggregates would be with the bank. How do we do that? Well, the Monetary Commission would print, if I may use that word, the missing 90%. But remember, it's already in circulation. There's absolutely no inflation involved in this whatsoever. How do we place that 90% into the banks? Well, we're not just going to give it as a present, thank you. There's a number of different ways of doing it. One of the ways is to simply have the Monetary Commission purchase the 90% that is already in loans. These are good loans. We run a good banking system. So what happens is in that purchase, you roll the cash into the banks and the loan assets to the Monetary Commission. The Monetary Commission divides these up into the mutual fund segments and puts those up for auction. What is the effect of this? In a heartbeat, the federal government would go from a net debtor nation to a net creditor nation. You see, what's the value of that 90%? It's in excess of $18 trillion. Currently, the U.S. federal government owes about $16.5 trillion. So we would essentially have all that paid off and still have enough money left to pretty well pay off most of the state debt. That's one way of doing it. We can have a citizen's dividend. There's a number of different ways of doing this. The details in this particular point aren't that important. The fact is that the government now is a net creditor nation, not the other way around. Let's just look at the steady state aspects just for a minute. And that's where Larry Kotlikoff comes in with his limited purpose banking, which that's what he calls it, the official title for it. And these are equity-backed loan funds. Because they're equity-backed, again, you can lose money, but the banks cannot have a run. It changes the whole system. What would this create? Here is a list of the conditions that we would have. This would be true intermediation and not gambling. It would be transparent and provide full disclosure. It would never collapse or put the economy at risk. It would not require government guarantees or threaten taxpayers. It would be sufficiently well structured so as to require limited regulation. Finally, banks would do what it is that pretty well most of us think banks actually do, which is to take money from savers and get that money to the hands of those who need to borrow it or need it for investments. Here is a list of prominent people who have either publicly stated their agreement or privately in conversations have done so, or have said, we need to thoroughly look into this. We know we're not going to create heaven on earth, so here's a portion of the speech from Lord Adair Turner giving some muted critiques of what it is that I have just described.
But there are some issues that I'm not absolutely clear that make this in total doable or necessarily desirable. First of all, I think that any system which involves a big write-off of existing debts, however hard you try, is going to somewhere in the system create winners and losers. I think it's almost impossible to do large debt write-offs without some distributional consequences. And I think that's just very difficult politically, as well as creating some simply uncertain consequences which will result from distributional effects on wealth. Secondly, I think there's an open issue about how we should think about lending for intertemporal consumption smoothing. I think there's far too much of it, but I think there could still be an argument that some of it is valuable up to a point. I mean, the basic process of saying we enable younger people to borrow money to buy houses off older people, rather than all houses flowing through an inheritance process or being bought by the accumulation first of enough cash to buy them. I'm not convinced that I think that may have a social welfare optimality. I think one of the most important bits of economic theory that we really haven't thought through is what is the social optimality there, how much is socially optimal, but I think that's an unexplored bit of economic theory. And even some element of lending from patient to impatient people, may be socially welfare optimal, even though it has absolutely nothing to do with creating higher growth. So I do have some concerns about the distributional issues, about how should we think about intertemporal consumption smoothing, and I do have some concerns that any attempt to create an entirely 100% reserve banking system would be likely to create more shadow banking systems, near money substitutes. I'm more doubtful than Michael is about the ability of us to prevent the creation of near money substitutes. And in relation to Larry's proposals, I'm not totally convinced that it would get rid of pro-cyclicality, given that I think that mark-to-market systems in the shadow banking system were themselves a cause of pro-cyclicality. I can imagine that if we have loan funds, mutual loan funds, in which you hold a mark-to-market investment, and if we can really mark-to-market those on a day-by-day basis, or even week-by-week, I think we may see some pretty strong pro-cyclical behavior in response, in self-reinforcing cycles, in response to the mark-to-market of the value of such funds.
Yes, we will address those points from Lord Turner. They do need to be handled. Back to the conference. At the end of the day, I did the final wrap-up speech and ended on a note of hope and encouragement. Because, ladies and gentlemen, I believe it's possible. I really do. Oops, oh, that says the wrong thing. It says change is not possible. I've been told that. As I told people what this conference was all about, I had a banker say to me, "Oli, it's impossible." And I go, "Really?" Here's an interesting chart. What this goes, you're going to have trouble reading it, goes from 1780 until essentially today, and maps out the major banking regulatory changes that have occurred over the last 200 years. Okay? It's not like we have not created major changes before. It's not like history has not seen events that demanded significant decisions. Why is today different? Today it's impossible. I know they could do that 50 years ago, or they could do that when we went off the gold standard, or they could do that when we created the Federal Reserve Bank. Well, we could do all those things, but today that's not possible. Something wrong with us, I guess. Yeah, we're the todayans. Todayans can't do these things anymore. I just want to show you something that's kind of interesting. If we were to draw a graph, where's my pointer here? If you look at the number of changes, it's essentially a parabolic curve. The closer we get today, the more changes have been created. Right? I want to tell you, we can still do it. As you see at the bottom, we have a history of making good corrections. Let's keep it up. Thank you very much. Well, it's obvious that the issues that we dealt with that day at the Federal Reserve Bank are ultimately very personal. They affect each one of us deeply. It doesn't matter whether we're in the economic profession or not. All of this is very important in our lives. So what can you do as part of the change that is needed in our system, I would suggest simply sign up to this current channel, come onto our website, get involved, learn more at realmoneyecon.com. My name is Kortsch. It's been my pleasure, and thank you for your time.